In this video, we're going to look back across time. The Bitcoin ETF was approved on the 10th of January 2024, and Ethereum looked like this. What did it do from there? Did it rally up and did it go to the moon? Of course, with Bitcoin improving in price, you would expect Ethereum would just go absolutely ballistic. In this video, we'll go through what actually happened and what you need to be prepared for, in order to make yourself more of a financial and emotional blessing to yourself and those you love. Let's run the numbers. Let's go forward a bit in history and see what happened to Ethereum when the spot Bitcoin ETF was approved. We had a follow through for a couple of days and then it got wobbly. And then you can see it started to come down. But how much did it come down? It came down quite a lot, nearly 18%. And of course, that's not just from the high. If we do it from the high, it was down over 20%. But let's just go with the more conservative figure, so I'll just move it back to here, around 18% down. This is precisely what the crypto market didn't anticipate whatsoever. They thought, and they were told, that Bitcoin would just go to the moon. And it kind of did, but after. Now, what are we seeing right now? We're seeing a level of turbulence inside the market. We've actually done really quite well, and the Ethereum spot ETF has been approved by the SEC. After the spot Bitcoin ETF was approved, we did get some positive follow through, but then it started to decay down, and it came down around that 18%. Now, what are we seeing here? If Ethereum does exactly the same thing as what happened when the spot Bitcoin ETF was approved, we would expect in around 13 days, ETH will move to approximately 31, 39. Just scaling back to the 10th of January 2024, when the spot Bitcoin ETF was approved, you can see we got follow through for the next couple of days, and then it decided to absolutely and utterly tank. It did so over 13 days, but it took around 21 days for it to come back to that peak. Now, something pretty interesting here. When you look at this 18% return, if you manage to buy right at that tip and sell when it got back to where it was, just at the first day of the ETF approval, it would go up nearly 22%. So down 18, up 22. You can make these percentages really work for you. You should never ever be concerned about negative price action, just getting in on the right side of it. And I'll show you something pretty good. If you just had bought Ethereum when the Bitcoin ETF was released and you were unfortunate enough to buy at the top of that very day, and then you hung on for 62 days and just sold at that very peak, you would have made 54.88%. And there's nothing wrong with that. That is a really good effort. But what if you bought right down here at that tip and you sold there? Let's have a look at the percentage difference. Remember 54.88. Now we have a very different scenario. Instead of being 54.88, it's actually 88.86%. What it means simply is this: if we're fortunate enough to get a retracement down to this kind of thing that happened last time a spot ETF was approved, it's an absolute gift, because crypto is the future. And you can see by all the legal activity all around the world, spot ETFs are being approved right, left and center. And that will continue to be the case. The biggest fund managers in the world are getting in, but they want to get in on the best possible price. They're going to make this work for them. So if, and I say if, because it's not guaranteed that we're going to get this kind of retracement, but if we do, I hope that you will see it's a very good thing to happen. And if you're putting money into something and you can't weather the storm to the negative direction, it's likely you never believed in it in the first place. Therefore, you could ask yourself, why am I putting my money into something? If you're just gambling, of course, that's one thing. But if you really believe in what is occurring, any kind of negative price action is an absolute gift. because it's all going up in time. If you're liking the content so far, please smash that like button and don't forget to subscribe. We have an incredible global family here, and just perhaps reach out and say hi in the comments. Students of the CTKS method understand that all of market price is bound by structural levels. We can see at this current time we've just got above an area of structural once resistance and now seeking to turn itself into support. If we manage to keep on going up, the next level is just over the 4200 mark. But if we start to decay, and especially these fresh air gaps where price can move very, very quickly down, we can see there's nothing really supporting that 3139 level. That could mean we could shoot through that in order to find deeper levels of structural support inside the markets. This is where the CTKS method really shines, because we get the X-ray vision on where smart money is going to accumulate or going to dump their positions. Institutional investors and traders are always trying to push the price down because they know if it goes down 50% and just comes back up to the level that it was, it didn't come up 50%, it came up 100%. This is the 10-5-10 rule, and one that you really need to understand. This is all knowledge that's contained inside the masterclass, this knowledge of trading and the knowledge of dealing with financial markets. You can reach out to the CTKS ambassadors, they can help you out. What we can understand, if we do get negative retracement, we would want it to stop above that 3200, because if it keeps on coming down, it's got a possibility of coming down into this 2500 zone. This should not be a cause of concern for you, because you remember that when it comes down, it goes up a heck of a lot more, and that's what it's all about. Another thing is to understand the dynamics of why price goes down in the first place. When price goes down, people become increasingly bearish. The shorts enter the market and they place their stops above current price action, expecting it to keep on going down and down and down. But when it doesn't keep on going down, the shorts get liquidated, and these short liquidations cause these big upticks in price. In other words, we often need price to come down first before rallying. Now, is it possible that price has already come down now and there are enough shorts in the market to justify upward price momentum? It is quite possible that that is the case. Always look at your structural levels and have your three-dimensional thinking playing out at all times. Just a quick note, over that same period of time, total crypto market cap came down 17.48% in the same 13 days. And Bitcoin came down in the same 13 days as well, 19.22%. If we saw Bitcoin coming down around the same, we would expect Bitcoin to reach 56,710. But that's only on this fractal. What you really need to understand are the structural support and resistance levels inside Bitcoin's price chart. We had fantastic news in the past trading session. Nvidia beat its earnings, and how? Unfortunately, after that video, we had some quite bad news that China has surrounded Taiwan, and of course some good news that the Ethereum ETF was approved, with China launching military exercises surrounding Taiwan, and understanding that Taiwan is the center of production for the advanced microchips that Nvidia uses. This has potentially caused all sorts of grief inside the main markets, and we can see the main markets sold off dramatically. We need to be aware of geopolitical tension. If China takes over Taiwan, and I'm not caring about the political ramifications of what I'm saying, I'm talking about the financial ramifications. Taiwan is the heart of semiconductor manufacturing globally. The US and China have been in a trade war over semiconductor chips, and you should understand that if China takes Taiwan, it will freeze the US out of the chip market, just like the US froze China out of the chip market. This means that we need to be really aware of the structural support levels inside the market, not just on Ethereum, but inside Bitcoin, inside the major indices, inside the major stocks. It's going to be really important to look at. In periods of market turbulence, it's essential to know what's happening with the Tier 1, Tier 2, and Tier 3 charts. The Tier 1 charts are the engine of financial markets globally. They show risk on and risk off, but understanding the levels on the Tier 2 and Tier 3 are very important because price is always moving between structural levels. And if you want to get the structural levels, you can pop across to ctksmethod.org. If you want to learn all about the knowledge, it's contained within the masterclass, and you can reach out to the ambassadors. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again in the next video. Bye for now.